Future Charter Financial Analyst, welcome aboard. Level 2 candidates, you're in the right place. We are going to get started in just a couple of minutes here. So sit back, relax, grab yourself a cup of coffee, a Red Bull, whatever you need. We got about 2 minutes till we get started. All right, folks, 2 minutes. And I will now entertain you with my DJing skills while we are waiting to get started. I got some my colleagues at UWorld back there. Sam, David, James, they're big time dancers. So hopefully you could see them. If they turn on their camera, they're going to do their moves for you.
Well, I don't know about moves, Pete, but the only good moves we want to see are like the good learning you're going to give to everyone tonight.
I'm too fast for the camera.
Did you add that cowbell?
What happened?
Did you add the cowbell in that?
The cow? No cow. You want the cowbell? I gotta bust that out. Hold on. I don't think I have that here.
I said hip, you don't stop the rocket to the bang bang. When you say up, jump the boogie to the rhythm of the boogie beat. Now what you hear is not a tap.
2 minutes, minute and a half, 90 seconds. Go, Sam.
Well, I'm dancing, but no one is ever going to see that, Pete.
Come on, Sam, do those moves. Do those moves.
I think not, but thank you.
I got to play something for Sam. Hold on. One minute. Go, Sam. $30 seconds. Any requests? Any requests out there? All right, here we go. I got your money. Let's go. All right, future charter holders. How are you? Sam, James, David, are we ready? Are we ready?
Yes, we are.
All right, I'm excited.
Yeah.
Yeah, all right, here we go. Well, thank you so much, folks, for joining us. Welcome aboard. We are going to use your time wisely tonight. You are going to become a resident expert at Intercorporate investments. So if you buy somebody you don't have significant influence, so you're going to treat it as amortized cost, fair value through P&L, fair value through OCI. What if you have significant influence? Then you got to know the equity method. And when you have control, you got to consolidate. And we're going to use full goodwill or partial goodwill. Tons of exciting stuff. But before we get started with all that, my name is Peter Olinto. I happen to be one of the lead instructors here for the CFA review program, as well as the CPA. So I've been a charter holder for quite some time. As you can see, the gray hair, so it goes back, way back. Yeah, so I'm very happy to be here. I'm a professional test taker. Yeah, I don't like to do the work, but past CPA exam, bar exam, different levels of the CFA. I'm proud to say I never had to retake any of those tests, but that is definitely not because I have a high IQ. And my colleagues here at UWorld who are on this call right now can attest to the fact that my IQ is in the left tail, but the difference between success and failure, level 2 in particular, is obviously, as you know, the time and effort you put in. You want to work hard, but you want to work smart. So you don't want to get lost in the weeds. You also got to use some good judgment. Anybody who's telling you not to study derivatives or some of the accounting topics because it takes a while to kind of get intimately familiar with the subject matter, listen, easy topic, ethics, no math involved, really crazy hard questions. I kid you not. If you thought the level 1 ethics was difficult, wait till you get to levels 2 and 3. So yeah, straightforward topic, the questions could be really challenging. On the other hand, some of the accounting, the derivatives, forward futures, option swaps, it takes a little while. I get it. The first time you go through it, you're probably not reviewing it. You're probably learning it for the first time. We get that. Although we're called a review course, we know that a lot of you are actually seeing some of this content for the very first time. So we'll teach you what you need to know to get through the exam. But most importantly, when you fight through it and you can master some of the tougher topics, exam day, the questions tend to be relatively straightforward for the tougher topics because the nature of the material itself is very challenging. So they don't have to go nuts making the questions really tricky like with the ethics. It's either that or the ethics just doesn't come to me naturally. I don't know. I mean, I was telling Sam the other day, so long as you don't get caught, that's ethical, right, Sam? Or is that not right? I don't know. I forget. That's why I don't teach the ethics. But we are very, very happy that you're joining with us tonight. So if you enjoyed what you're seeing here and you want to enroll with UWorld, we want to thank you for your time monetarily. So 25% off the retail price. So you've got this QR code here, which I'll put up again on the back end. But yeah, this is what it is. So we appreciate your time tonight, okay? So it's a free event monetarily, but not free in terms of your time. So we are going to use your time wisely. With that being said, Sam, I am, or James, is there anything by way of intro I did not say that I should have said? If you want to say hello real quick, is there anything you guys want to add to my intro?
Well, Pete, no, there's no way you can improve on perfection, but I just wanted to say thank you to all the people who are attending this. My name is Sam Gottlieb. I'm the Director of CFA Education here at UWorld, and we're really glad to have you with us. You're really going to get a lot of good information from Pete tonight, and you know, I would take all the advantage of this and his knowledge and experience that you can. So having said that, Pete, it is all yours.
All right, here we go. So folks, we're going to learn by doing. All right. So this is a lot of what we do in the course as well, especially when it's math intensive. We're not going to lecture math. You got to see it being done. So we're going to go through questions again, high level. My goal is to cover debt securities, preferred equity, common equity, where you have no significant influence. I'll review those concepts. Then I'll talk about equity method as well as consolidation. So let's start with our first question. Exam day, folks, before you read through the facts, I call it legalized cheating. You generally want to start with the question stem so you could get a feel for, hey, what's the topic? What are the rules I've got to be looking for, etc. So they tell us at the end of year 1, what are we going to report on the income statement and the balance sheet, respectively, if this investment in Swiss Landing Company is classified as held to maturity. Now, held to maturity is also known today around the world as amortized cost. So, folks, this is a debt security. With debt securities, you have no voting rights. So there's no significant influence, folks. No voting. If you don't get the vote, there's no way you can have influence on the company. So amortized cost. Then you're thinking, what are the rules? Well, on the balance sheet, we do not mark to market value. It's on your books at amortized cost. Do not, they're going to give you market value. Do not mark to fair market value. Now, on the income statement, what you're going to have is interest income. There should be no unrealized gains and losses. Why not? Because you're not marking to market value. And if you're going to hold it to maturity, there should be no realized gains and losses because you shouldn't be selling it. Now, legally, they can't stop you from selling it. Okay, but the held to maturity. But if you do sell it, I'll show you how to calculate the gain or loss. Okay, so basically, you do not mark to market value. You just got to put it on the books at amortized cost. All right, so they tell us now in the first year, Eastern Inc. invests $150,000. Therein lies your cost. In Swiss Landing, we bought debt securities. The par value of the securities is 160. We only paid 150. Now, be careful, folks. We're doing this from the perspective of the investor, the buyer. Let me just quickly review, but what if you're the issuer? What if you're the borrower? What do they do? No journal entries, folks. What you got to know for the exam, well, if you're issuing, what's the cash received? You have a financing inflow of 150,000. Okay, that would be your financing inflow. But now you got to repay the face value. 160,000 is going to be your financing outflow. Your initial carrying value has to equal the cash received. So your initial carrying value is what you sold it for, 150. This is a loser. You're borrowing 150, but you got to repay 160. That's a loss, but we don't call it a loss because that would violate the matching principle. Instead, what do we call that $10,000? A deferred loss, an unamortized, a currently unrecorded loss, an unamortized discount. Okay, DISCO, I'm just going to abbreviate DISCO, an unamortized discount. Okay, little by little, that discount will be amortized over the life of the bond by making the interest expense greater than the coupon paid. So as we record the discount, the unamortized amount goes down, the carrying value is going to get pulled up towards par. So people ask me, hey, Pete, is a discount a gain or a loss? I don't know. Which side of the fence are you on? Because if you're the issuer, the borrower, that discount is a deferred loss. We call it an unamortized discount. Your interest expense every period will be greater than the coupon paid. On the flip side, if you're the investor, which we're doing here, folks, we're going to be on this side of the coin. You're the bond holder. That's a deferred gain. A deferred gain. Your interest income is actually going to be greater than the coupon received. And this is what we're focusing in on tonight. All righty. So they tell us we paid 150, face value 160, 4%, that's your coupon rate. That's going to dictate your coupon payment, not your interest expense. The only time, your interest income. The only time your interest income is going to equal the coupon received is if you buy it at par. We didn't buy it at par, we bought it at a discount. So what do we know? Our interest income will be greater than that 4%. They tell us at the time of the purchase, the market rate was 5%. There's your yield to maturity. Makes sense, right? My yield would have been 4 if I paid 160, but because I paid less than 150, my yield to maturity is greater than my coupon. So your coupon divided by the price, there's your yield. Anytime you buy it at a discount, you're expecting your yield to be greater than the coupon received. All right, exciting stuff. We are kicking ass, baby. They tell us, let's see, well, he bought it at fair value. When he bought it, fair value is 150. Now, the fair value at the end of year one, 145. That is distractor information. When you put the debt on your books at amortized cost, that's distractor information. That would be relevant if it were fair value through P&L or fair value through OCI. Fair value through P&L, still called held for trading in practice in a lot of places. Fair value through OCI, a lot of people still refer to it as available for sale. Depends upon what region you are around the world. So you can see that terminology still lingering. Okay, so question number one, they want to know, what are we going to report on the income statement if it's initially classified as held to maturity? So here we go. Put the pen to your paper. What you write, you will remember. And folks, take a screenshot if you want those facts so you can review, get your money's worth. All right, free questions. So let me show you no journal entries from the perspective of the investor, the bondholder, our side. What happens to their balance sheet when they buy this investment? Well, cash just went down by, what did they pay? 150, dropping the zeros. Investment in debt securities, 160 is the face, but they didn't pay the face. They got a 10,000 unamortized discount, folks. That is a contra asset that reduces the carrying value of this asset. So the carrying value of this investment is 150. So a current asset went down, a non-current asset just went up. Total assets, no change, all right? Total assets, no change. Now, your current ratio is going to be lower than what it was because instead of having that cash, we made an investment, so our current ratio is lower, but total assets, no change. As we amortize the discount, by making the interest income greater than the interest expense, the carrying value is going to get pulled up towards par. All righty, so let's take a look now. What was that coupon rate? 4%. Am I correct on that? 4%. So let's take a look at our coupon. You ready? Our face value, 160 times our coupon rate. And I do believe it was annual paid. So our carrying value at the beginning of the period, 150 times the market rate, which I believe was 5%. Your market rate was 5%. This is how the investor gets their interest income. So my interest income is going to be 7.5, 7,500 dropping to zeros. Yet the coupon received, the par value, 160 times the coupon rate, 6%, excuse me, 4%. I'm making up my own numbers, right? Coupon was 4%. So the par times coupon, 6,400, 6.4. The difference between the interest income that goes on the income statement and the cash received that goes on the statement of cash flow. Where does that go on the statement of cash flow? Under US GAAP, that's going to be cash flow operating. Under IFRS, that interest, that coupon received under IFRS could be cash flow operating or cash flow from investing. The difference between the two, that's a little piece of that discount, the amortization of the discount. All righty. So the carrying value was 150. The carrying value is now going to be 150 plus that 1.1. The carrying value now 151.1. Do not mark to fair market value. We do not mark to fair market value if it's on the books at amortized cost. So, you ready? Our interest income on our income statement, $7,500. The carrying value on the balance sheet, 151.1. All right, that's if we account for it at amortized cost. So we just answered our first question. What's going to be on the income statement and what's the carrying value on the balance sheet? The income statement is not the coupon. That is the most common wrong answer choice. The coupon received only equals the interest income if you buy the bond at face value. We didn't buy it at face, bought it at a discount. So 7,500, and the carrying value is being pulled up towards par as we amortize the discount. One question down, 450,000 to go. Isn't this fun stuff? Come on, man. What would you rather be doing? All right, question number 2. What if it's initially designated instead at fair value? Okay, what if they designated at fair value? So if they designated at fair value, if classified as a fair value investment, that means you're going to use your held for trading rules, fair value through P&L. Your balance sheet, we're going to mark to fair market value, 145. And on the income statement, you're going to report your interest income, realized gains and losses, as well as unrealized gains and losses. All righty. So if they decide instead to designate it at fair value, you ready? 145. What is the carrying value? How do you find your gain or loss? If it's designated at fair value, unrealized gain or loss on that debt security. It's the difference between the amortized cost, 150, plus the 1.1, 151.1, what the carrying value would have been if it was on the books at cost, but that's really amortized cost, where the carrying value always gets pulled towards par, versus the fair market value at the end of the year. And I do believe the fair market value was 145. So folks, we have a loss and that loss is 6.1. Okay. If it's fair value through P&L, that's going to go on the income statement. If instead it's fair value through OCI, what we used to call available for sale, then that would go on the balance sheet as part of other comprehensive income, direct to equity. All righty, direct to equity. Okay, so let's take a look at this question again. They tell us, will that loss be reported? Let's see. I'm sorry, if Eastern is designated at fair value at the end of the year, most likely an unrealized, what are we going to have? A loss, but not OCI. That's if it's fair value through OCI or available for sale. That's the most common wrong answer choice. We don't have a gain, we have a loss. And where's that loss going to go? On the income statement. When an asset is designated at fair value, anytime an asset is designated at fair value, that means you use your fair value through P&L, your held for trading rules apply. Okay, your held for trading rules are gonna apply. All righty, let's try another one. What if Eastern initially designates the investment in Swiss Landing as available for sale instead? Then on the balance sheet, we are gonna mark to fair market value. It'll be 145. The difference is that unrealized loss of 6,100 is going to go direct to equity, part of OCI. Interest income, not the coupon received, the interest income, the carrying value, 150 times that market rate at issuance, 5%. That's 7,500. That'll go on the income statement. Okay, now reading comprehension, folks, they want to know which of these is least likely to be accurate. So the correct answer is a false statement. If it's true, it's an incorrect answer. The security is going to be reported on the balance sheet at the end of the year at 145. That is a true statement, thus an incorrect choice. The unrealized loss will be reported, let's see, the unrealized loss will be reported as OCI in year 2. No, in year 2, not year 2, that 145 would be reported at the end of year 1, right? So per the facts, that 145 was the carrying value at the end of year 1. Now they sell the investment in the first day of year 2. When you actually sell it, that gives rise to a realized gain or loss. So the unrealized loss is in year 1, not year 2. The unrealized loss, folks, is in year 1, not year 2. I'll show you how to do the realized loss. So that is actually the correct answer because that's the false statement. C is incorrect because it's also true. The carrying value used to determine the gain or loss at the time of sale, is that greater than the initial price of the investment? That's a true statement and thus a wrong answer. How is that true? The carrying value at time of sale, okay, to determine the carrying value used to determine the gain or loss at the time of sale, is that greater than the initial price versus the initial price? What was our initial price? 150. What would be the carrying value at the time of sale? To calculate gain or loss, if it's classified as available for sale, fair value through OCI. It would be your amortized cost at the time of sale. It'll be your amortized cost, 150 plus the 1.1, 151.1. Is that in fact greater than our initial purchase price? Yes, it is. Okay, so what I want to do with you now is show you how you calculate your gain or loss, all 3 classifications. So if it's classified as fair value through OCI, available for sale, that category, you take your selling price minus the amortized cost at time of sale. That's how you get your gain or loss. So our selling price is the same as the fair market value at the end of year 1 they sold it a day later on the first day of the year. They sell it for 145. So you take your selling price, 145 minus the amortized cost at the time of sale, 151.1. They're going to record a loss of 6.1 on the income statement. But here's the key. You've got to reverse any profit or loss on unrealized gains or losses that went direct to equity. So folks, in year one, we recorded a loss of 6.1. We've got to reverse that. Okay, so we recorded a loss of 6.1. We've got to reverse that. That'll make equity go up. And then by putting this loss on the income statement of 6.1, equity goes right back down. You don't want to double count the loss. We're just moving it from OCI onto the income statement, and now it's going to make retained earnings go down, because if the net income goes down, your retained earnings goes down, equity goes down. So whenever it's a debt security classified as fair value through OCI, the way you calculate your gain or loss is selling price minus amortized cost at the time of sale. And then any profit or loss that had gone direct to equity gets reversed. Okay, what if they classified it as fair value through P&L, also known as a trading security or held for trading? You take your selling price minus the carrying value at time of sale. Selling price 45, 145, carrying value at the time of sale. We marked it to market value last year, marked to fair market value. 145, 0 in year two. We had already recorded the 6.1 loss, already went on the income statement in year one, making net income lower, which made your retained earnings lower, which made your equity lower. Okay, made your retained earnings lower, which made your equity lower. Now, what if they had classified it, kept it at amortized cost? There's no mark to fair market value. So it's your selling price minus carrying value at time of sale, which would be amortized cost. By the way, this is called sometimes held to maturity. That's still thrown around, but amortized cost. So the selling price, 145, the carrying value at the time of sale, the 150, we amortized in year one, 1,100 of the discount, 151.1, 6.1 loss, which would go on the income statement, making retained earnings lower, making equity lower. So under any methodology, you're going to wind up with the same equity on the balance sheet, retained earnings lowered by 6,100, equity lower by 6,100. Okay, now, next item. I want to review with you when you have different types of investment, debt and preferred equity, you have no voting rights, folks, no voting. Thus, the only way to account for that, no significant influence. Either it's going to be fair value through P&L or fair value through OCI or held to maturity, amortized cost. And that's pretty much for debt only, because that's held to maturity. Preferred equity, unless it has a mandatory redemption, held to maturity, that's debt only. All righty. Now, if it's common equity, now you got to be careful. With common equity, you have voting rights. So since you have voting rights, there's three potential ways. With common equity, that could be fair value through P&L, okay? Or fair value through OCI under IFRS. Under US GAAP, we only allow fair value through OCI. Under US GAAP, only allows fair value through OCI for debt security. So possibly preferred equity if it has the mandatory redemption, in which case it's like debt. All right. But IFRS common equity, fair value through P&L or fair value through OCI if you have no significant influence. How do I know that? You own less than 20%. Now, the 20% is a benchmark, but it's not controlling. You got to look for other facts. You might own 15, but have significant influence because somehow you have a seat on the board. Or you might have 25%, but have no significant influence because you don't have a seat on the board or whatever. So the 20% is a benchmark, but look for other facts. You might use the equity method of accounting. Equity method, which I'll illustrate, that's when you have significant influence. Significant influence. And look for ownership of at least 20 and not more than 50. Again, that's the benchmark. You've got to have a seat on the board, some influence over policies and what have you. Now, you're going to have to use the acquisition method. You've got to consolidate. Anytime you have control where you own more than 50% of the voting stock, or it's a special purpose entity, that variable interest entity, where even though you don't have control, at the end of the day, you're absorbing the majority of losses, you have the majority of the profit, this entity was set up to benefit you, you got to consolidate, okay? With consolidation, there's two ways to consolidate. Full goodwill, US GAAP, you got to do full goodwill, full or partial goodwill method, full or partial goodwill method under IFRS. US GAAP is very strict. They say you got to use full goodwill. All righty, one down, 5 million to go. Sam, James, how we doing, baby? You enjoying this? Is everybody enjoying this? Is this fun stuff? Are they excited? Are people typing in like this is the best day ever?
Give me more. I want more.
Yeah. Oh, well, come on, that's from Greece. Give me more, give me more. Like, does he have a car? Give me more. Nah, that's not how the song goes. All right, shut up, stupid. Keep going. All right, so here we go. I got all these facts. I have no idea what to do with all these facts, but I got some questions. So what do we call it? Legalized cheating, folks. You ready? What's the amount of goodwill that I'm going to report on the post combination? So if I'm consolidating, if I'm going to consolidate, then I need to know, am I going to do full goodwill or partial? Which, by the way, only applies, the full versus the partial only applies when you buy less than 100%. You own at least 50, but not 100. Then you got to worry about the full or the partial goodwill. When you buy 100% of another company, full and partial are the same thing. All right, then they also want to know, hey, what's your additional paid-in capital? All right, so let's take a look at what we got. They tell me Prime Inc. acquire. Here we go. 100% wholly owned. So partial goodwill, full goodwill, throw it out the window. It's all the same. Partial and full goodwill only apply when you own less than 100, but not more than 50. So you don't have to worry about full or partial goodwill. All right. How did we buy this company? We issued 1 million shares. Is that a sign of optimism or pessimism? Pessimism. Because I'm going to make you my partner. You ain't going anywhere. Just in case you gave me false information to entice me to buy your business, I ain't giving you cash. No way. I'll give you my stock for your stock. And if you gave me false information and I go down, I'm taking you with me. If I'm more optimistic, I'll pay cash. And if I'm really optimistic, then you know what? I'll borrow the money to pay you and buy you out. Okay, so that's corporate finance issues, as we're going to see later. All right, so when you buy stock of another company, how do we pay? So when you buy stock of another company, how do you pay for it? That's the key. How do you pay for it? All righty. So what's going to happen is on your balance sheet, if you pay cash, cash goes down, non-current assets, an investment in the subsidiary is going to go up. Total assets, no change, just a change in form. Total assets, no change. Or maybe you're going to pay with debt. Non-current assets go up. You've got this investment in this subsidiary. Non-current assets go up. Debt goes up. You borrow. So if parent liabilities go up, consolidated liabilities go up. If the parent pays with cash, if parent cash goes down, consolidated cash goes down. Now, oftentimes I get a question and say, wait a second, Pete, if the parent is giving the money to this investment, doesn't it stay within the consolidated group? No, because the parent doesn't pay the money to the entity. The buying company pays it to the shareholders, of that company that are being bought out, taking the cash and going away. So when the parent pays cash, the parent cash goes down, consolidated cash goes down. If the parent pays with debt, parent liabilities go up, consolidated liabilities go up. If the parent issues their stock for the other company's stock, investment in subsidiary, non-current assets go up, parent equity goes up. Use the fair market value of the equity, okay? So parent equity, parent paid in capital, the parent's stated capital and additional paid in capital go up. So consolidated equity is going to go up, all righty? Consolidated equity is always equal to the parent stand-alone equity. Post-consolidation plus any non-controlling interest. Sometimes they call it a minority interest. Okay, plus any non-controlling interest. All righty, so how did we pay for it? All righty, so when you buy and you pay cash, folks, when you buy and you pay cash, if you pay cash, where does that go on the statement of cash flow? That would be an investing outflow. So as a general rule, folks, as a general rule, anytime you pay cash, it's generally an investing outflow. What's the major exception? When you pay cash and it's classified as a current asset, which is generally the case if it's held for trading, fair value through P&L, held for trading. Anytime it's listed as a current asset, then it's cash outflow operating. Cash outflow operating. All right, so let's see what we got. You ready? I'm excited. I'm excited. Here we go. Okay, so we issued 1 million shares of our stock. The par value is $1.50. That is distractor information for right now. I want to know what's the fair market value of that stock. At the time of the transaction, $15. So here we go. My purchase price for this 100% stake. Step number 1, purchase price for that 100% stake. 1 million shares times a fair market value of $15 per share. $15 million dropping to zero. Less 100%, because we bought all of it, 100% of the fair market value of the identifiable equity. Now, what do I mean by the fair market value of the identifiable equity? I want the fair market value of the identifiable assets on or off the balance sheet, folks. I just want to know, does it have a value? Now, the accounting rules might say, hey, let's be conservative. This doesn't have a value. You know, let's expense it immediately to be conservative, like R&D. Nonsense, though. That in-process R&D might not have a book value, but it might have a substantial fair market value. And when you internally develop your own patented products, the book value of that is very low. It's pretty much the legal fee to get your patent protection. But the market value could be astronomical. So we want the fair market value of all assets on or off the balance sheet. Then I want to subtract from that the fair market value of all identifiable liabilities. Same thing, on or off the balance sheet. I don't care what the accounting rules say about, hey, is the loss probable? Can you reasonably estimate it? Nonsense, man. I want to take a look at this for myself and determine, you know what, what's the present value of some payment I may have to pay in the future. And I'm going to put that on the balance sheet when I value the company. And I don't want the book value of the company's liabilities. Now, how do you get fair market value? The book value of liabilities is when you discount the future payments at the cost of borrowing when the debt was issued. The fair market value of debt is calculated by calculating the present value of the future payments and discounting it back to today using the current market rate. All righty, that's the difference. All right, difference between the two. Therein lies the fair market value of the identifiable equity. All right, so I look at the facts. They tell me, here's the book value of the parent, the buying company. Here's the book value of the subsidiary versus the fair market value of the subsidiary. I'm looking for the fair market value of the subsidiary. That's what I want. So their total assets, here's the fair market value of the identifiable assets. Here's the fair market value of the identifiable liabilities. They did the work for me. The fair market value of the identifiable equity is $77.20. So let's take that purchase price of 15 million for 100% of this company. 100% of the fair market value, the identifiable equity, 7720. 7720. So the difference between the two, why did you pay an extra 7280? What the hell's that about? That is unidentifiable excess. I have no idea why you didn't pay 7720. You paid almost double that. You paid 15 million. What the hell for? I don't know. But we can't have something called I don't know. That would make all the MBAs look bad. So what do we call I don't know to protect the MBAs? We call it goodwill, but actually it's I don't know, man. Supposedly, you know, it's that intangible, you know, brand and customer and reputation, all that crap could be here today, gone tomorrow. Very suspect. Just because you paid 15 million doesn't mean anybody else would. You might try to sell it the next day and not be able to sell it for anywhere near 15 million, and that could wipe out that goodwill just like that. All right, but nonetheless, that's what we call goodwill. So question number 1 is done. Therein lies your goodwill, 7280. All righty, now how did we finance this acquisition? We issued our own stock, 1 million shares, par value of 1.5. This is the parent company's pre-consolidation balance sheet. This is the pre-consolidation balance sheet. So folks, the capital stock's no longer 9 million. The capital stock, the stated capital. We just issued 1 million shares. 1 million shares times the par value of 1.5. That's 1,500,000. The capital stock, also known as stated capital, is now going to be 9 million plus that 1.5 million. That is now going to be 10.5 million. And the additional paid in capital, 1 million shares, fair market value of 15 minus the par value of 1.5. Well, that's 13.5 times 1 million shares. Additional paid in capital is going to go up by 13.5 million. So the additional paid in capital was 12 million. Add another 13,500,000. That's 25,500,000. All right. So stated capital just went up. Additional paid in capital goes up. Retained earnings, no change. All righty. So the net assets were 42,500,000. Your assets minus your liabilities get you obviously your net assets, or add up the individual pieces and you get 42,500,000. 42,500,000 was the parent equity. That was the parent equity pre-consolidation, pre-acquisition, parent equity pre-acquisition. We issued 1 million shares with a fair market value of $15 a share, 15 per share. That's $15 million. So the parent equity post-consolidation, 57,500,000. That is the parent equity post-consolidation. Now, parent, or I should say consolidated equity, is going to equal your parent equity post-consolidation plus any non-controlling interest. The non-controlling interest here is 0. The parent equity post-consolidation is 57,500,000. That means consolidated equity is going to be 57,500,000. Another way to get consolidated equity, consolidated assets minus consolidated liabilities, that's another way to get your consolidated equity. All right, so we got a couple of different ways of arriving at that 57,500,000. Let's answer this specific question. They want to know what's going to be your total assets, total assets on the post-combination balance sheet and additional paid in capital. Well, we've already solved for the additional paid in capital piece. The additional paid in capital post-consolidation is the parent standalone plus the 13,500,000. The fair market value in excess of par, 13.5 per share times 1 million, 13.5. The additional paid in capital is 25,500,000. So we know the answer's got to be But how else can we get that 91,850,000? You ready? How do we get that 91,850,000? What are our consolidated assets? Folks, your consolidated assets, the parent assets, okay, the parent assets, book value. You take the book value of the parent. If they ever give you fair market value of the buyer, that's distractor information. Book value of the parent plus the fair market value of the subsidiary, 70 million plus 14 million. Well, hey, that's 84 million 570. Now, that's certainly not what we have here, 91,850,000. Where the hell did they get 91,850,000? Folks, whenever you buy a company, you said, remember that goodwill we calculated, that goodwill of 7280? The goodwill has to be inserted as a non-current asset on the consolidated balance sheet. The only place you will ever find goodwill is on a consolidated balance sheet, okay? That is the purchase price in excess of the fair market value of the identifiable equity. There's no full or partial when you buy 100% of the company. It's a moot point. I'll show you partial and full goodwill later when you buy less than 100%. So now let's take that 7280 and add that in. So we've got the total assets. Here we go. Parent company, 70 book value. Fair market value of the sub plus that 7280. When you add it together, what are our consolidated assets? 91,850. Why am I screaming at you guys? Because I have one volume, obnoxious. All righty, but there it is. There are your consolidated assets. Now, what are your consolidated liabilities? You ready? Parent liabilities, book value. Fair market value of the subsidiaries liabilities. Fair market value of the subsidiary. So now let's find our consolidated liabilities. So our consolidated assets, I want to keep this as neat as I can. Consolidated assets were the 70 million plus the 14,570,000 plus the goodwill of 7280 for a total of 91,850. So that was the parent book value, the subsidiary fair market value, and the goodwill. Consolidated liabilities, the parent liabilities 27,500 plus the subsidiaries liabilities at fair market value 6850. The sum of the two, 34,350. That gets us our consolidated equity. What's our consolidated equity? 57,500,000. Consolidated equity has to equal what? Parent equity post consolidation plus any non-controlling interest. What was the parent equity again? Post consolidation. The parent equity post consolidation, what did we say that was? 57,500,000. Where was that? Parent equity post consolidation. Where did you go? I know I did it somewhere. Parent equity post consolidation. There it is. Parent equity post consolidation. Parent equity 42,500,000. Parent equity 42,500,000. Plus the fair market value of the stock issued in that acquisition, 15 million. Sum of the two, 57,500,000. Whoop. There it is, baby. All righty. And the parent equity post consolidation, parent equity post consolidation, the stated capital, 10,500,000. The additional paid in capital, 25,500,000, and the retained earnings, 21,500,000, 57,500,000. Breaking it piece by piece. And the stated capital of 10,500,000 and the additional paid in capital of 25,500,000 was the parent standalone number, stated capital 9, plus the par value of the stock issued, additional paid in capital, parent standalone, plus the additional paid in capital with the stock issued, 10,500,000, 25,500,000. Whoop, there it is. Now look, I'm a CPA by trade, taught accounting for many years. If you're learning this for the first time, you know what? At best, the light bulb might be flickering a little bit right now. All right, I get that. What we do here is not the way we teach it on the video course. Just so you know, the video course doesn't start with problems. It starts by explaining the rules, then giving basic examples. What I'm doing here is kind of like the highest level of application, actually jumping into multiple questions like an actual vignette, an actual problem, okay? This is at the highest level of application. So if you haven't studied intercorporate investment yet, relax. Okay, the light bulb flickers, you go back, you review the rules. So the way UWorld has set up the CFA course, which is phenomenal, they write the text, tons of practice questions. We've got the videos that walk you through the rules step by step. Nice, not reading to you. That's not what we do. We go through problems, examples, basic to illustrate. You then try practice questions on your own. Then we have Saturday live online virtual classes where we then do what I'm doing here tonight, which is actually practice application. So you get it all. And you know what you need is dependent upon the topic you're studying. Like I got equity analysts that they say, Pete, I don't need to watch you talk about free cash flow to firm, free cash flow to equity, residual income, dividend discounts, what I do. So they're not going to watch that video. They'll go right to the questions and maybe attend the Saturday class to see what the vignettes look like, you know, if it's an area of expertise. You know, so everybody's got their strengths and weaknesses. The pieces of the puzzle you choose to utilize are dependent upon your personalized background. But man, if you said to me, Peter, I don't know anything, then we got it all. We'll walk you through every topic. But it's not going to take you 300 hours. It might take you closer to 1,000 hours, but you could do it if you want to. All right. Let's go, baby. Let's try another one. Ready? Question number 4. So we got question number 4. Nah, it's a pooling. I don't want to do that one. That's not a fun one. I want to do a fun one. Here we go. Let's try this one. Okay, if this is exam day, I have no idea what to do with all these facts. You don't start there. Let's take a look at the questions first. Let's see what they want us to do. What's the equity income the YZ has to report on its income statement? They just gave me the formula that I've committed to memory to calculate equity income. So you ready? What you write, you will. As a professional test taker, folks, you know what I could tell you? You got to engage as many senses as you can when you study to remember that information. Watching lectures is great, listening is great, but you got to put the pen to the paper and speak it. That's right. What you speak and what you write, those senses, when you engage that, is going to embed that in your memory long term so you can remember it exam day. All right. So you shouldn't be dating. You know, if you're on any of those dating apps, get off, because Tinder will only hinder your performance. You don't need any of that crap. It's a distraction. But should you be out on a date and you want to see, hey, do I possibly have my soulmate sitting across from me? Talk to them about the equity method of accounting. And if they're still there at the end of the date, you know you found your soulmate. And I also hope you have good health insurance, because they probably have mental health issues, but that's another story. All right, so equity method of accounting. You ready? Here is your formula. Write it down with me. Here we go. You're going to start with your beginning carrying value, your purchase price. That's what you start with, your beginning carrying value, your purchase price. You are going to add your percentage share of that subsidiary's net income. You are going to add, actually, you're going to subtract your percentage share of what I call excess depreciation. You're going to see what that is. You're going to subtract your percentage share of derecognized profits. You'll see what that is. And then you are going to subtract your percentage share of dividends. That's right. Dividends are not income. Under the equity method, they are not income. They are return of your investment. It reduces your carrying value. This is how you're going to get the ending carrying value on the balance sheet. Do not mark it to market value unless it's permanently impaired. We do not mark to fair market value. That will be distractor information. The sum of these 3 items right here, the sum of those 3 items, that is your equity income that will go on the investor's income statement. You know what they call the equity method of accounting? They call it one-line accounting. Why one line? Because all I'm going to see on my income statement with respect to that investment, equity income from that investment. That's it. And on my balance sheet, you know what I'm going to show for that investment? My ending carrying value. That's it. I do not see the subsidiary, the affiliate, the subsidiary, or if you want to call them an affiliate, I do not see their assets and liabilities. No idea. I don't see it. And the affiliates' revenues and expenses, gains and losses, their revenue, expenses, gains, and no idea. I don't see it. Okay, you are not consolidating with the equity method. So it's not very transparent because I have no idea if this equity income is sustainable or not because I don't know what's driving it. Okay, I'm picking up this as an asset, but I have no idea what the liabilities are of that affiliate. No clue. All right, so it's one line. That's it. Not very transparent. All right, so what I want to do here with you is the following. When do you use the equity method of accounting again? You're going to use the equity method anytime it's common equity. You got to have significant influence. And what is evidence of significant influence? You own between 20 and 50. Okay, 20 and 50. I own 30%. As soon as I see that, I think, hey, equity method. And then I immediately think, oh yeah, dividends are not income. They are not. They are return of investment. And do not mark to fair market value. They're going to give you fair market value, but that is distractor information. All right. So YZ Invest. So YZ is the investor, the buyer, the investor. GC is the investee. All right, so they buy 30% of the investee. The two companies have done business together for many years. This investment increases YZ's influence. They have influence over operational, so they're telling you they have significant influence. Here is the book value and fair value. All righty, I don't want the fair market value, I want the book value. Now notice the PP&E, the book value is 30 million lower than the fair market value. Just want to make note of that. Okay, liabilities. So here we go. Fair market value of my identifiable assets. Fair market value of my identifiable assets. Here's the fair market value of my identifiable liabilities. Herein lies the fair market value of that identifiable equity. What percent did I buy? 30%. How much did we pay? We paid 75 million for a 30% interest. So here we go. No journal entries, folks. You got to understand big picture. So from the perspective of the investor, they paid $75 million. It looks like cash. Cash is going to go down by 75 million. Current assets are down. Investment in affiliate, a non-current asset, is going to go up by 75 million. Total assets, no change. Total assets, no change. Just the change in form. Current assets down, non-current assets up. We are less liquid now because we use cash to make this investment. All right, total assets, no change, just a change in form. Okay, so now let's set it up. Purchase price, 75 million. So my purchase price, and I do believe we bought a 30% stake. My purchase price for that 30% stake dropped to zero, 75 million. Less the fair market value of the identifiable equity. We said that was 80 million times my 30% stake. Logically, you would have thought we would have paid $24 million, but we did not. We paid 75 million. Why? I don't know. Maybe you got OCD issues and there was a bidding war and you got caught up emotionally and now you've overpaid. But I have no idea why you paid almost tripped, man. You got to be kidding me. But folks, that is unidentifiable excess. That is goodwill. Really, it's unidentifiable excess, and that's a lot, 51 million. But here's the thing, we are not consolidating. We are not consolidating because there's no control. Therefore, this 51 million does not appear anywhere on the investor's balance sheet. That 51 million, this is what's on the balance sheet, the purchase price. The purchase price, that goodwill, this is a problem. That's embedded in that carrying value of 75 million. It is not separately reported. That's problematic because I'd like to know why in the hell you spent 51 million more than the fair market value. I can see spending more than the book value. Okay, now as a matter of fact, in this question, what is the book value here? The book value of the equity, 50 million. Okay, the 50 million. All right, so our purchase price 75 million. Purchase price 75 million. Okay, for a 30% stake. All righty, now 30% of the book value of the equity, 50 million times 30%, 15 million. The unidentifiable excess is $60 million over book value. $60 million over book value. Okay. So, I could see paying over book value, but why in the hell did you pay, over the fair market value? So that's another story. All righty, that's another story. So why did you pay so much over the fair market value? I don't know. Now, the question becomes, can any of this over the book value be identified? Yeah. Okay, and that's not all. That's excess over book value. Let me just properly label it. Excess over book value. Okay, now can any of that be identifiable excess versus the unidentifiable excess? We know the unidentifiable excess is that 51 million. Okay, can anything else be identified? Yeah, on the balance sheet, remember we pointed out $30 million of PP&E where the fair market value is greater than the book value? 30 million times the percent we bought, 30%, 9 million of that 60 million is identifiable. Okay, I understand 9 million of the excess over book value. Okay, that's identifiable. That's PP&E. That's 30% of the fair market value over the book value for the PP&E, that 30 million. But what in the hell's the deal with the other 51 million, right? 60 minus 9, there's that 51. I don't know. All right, but that's embedded in the purchase price. Okay, now let's start popping in numbers here. Now, legalized cheating is beautiful because I already got this set up. All right, so I just want to erase this so I have room to write. Let me show you the numbers now. You ready? My purchase price, $75 million. Did this affiliate have any net income? Well, they tell us GC accounts for its plant and equipment. That's the buyer. That's the investor. The investee. Okay, that's the company. YZ, investor. And then we've got GC, the company they invested in, and they bought a 30% stake. Okay, so YZ bought a 30% stake. All right, I always want to be mindful of that. Okay, so now they account for this plant and equipment using straight line depreciation. You see this fair value over book value for PP&E? So long as it doesn't relate to land. Land doesn't get depreciated, but any other PP&E, fair market value over book value, that excess of fair value is 30 million. Well, that's going to have to be depreciated over that 10-year period. So that excess of 30 million divided by 10 years, the quote unquote excess depreciation is going to be 3 million per year. 3 million per year. Okay. Now, GC, the investee, reports net income of 20 million. They pay dividends of 5 million. It quickly becomes information overload. Start plugging in as you get the data. So the investee, their net income was 20 million. How much of that belongs to us? Just 30%. So take that 20 million, GC's net income, 30% of that belongs to us. You add $6 million. Excess depreciation, we said, was 3 million. How much did we buy? 30% of the company. So that's 900,000 of excess depreciation that's going to reduce our equity income. Okay, dividends. Dividends, they just said, were how much? Short-term memory, not 5 million. How much of that belongs to us? 5 million times 30%, 1,500,000. That is not income, but that reduces my carrying value. Okay, now I go back to my facts. GC sold inventory to YZ. Folks, that's called an upstream sale. Upstream, from the investee to the investor. Okay, easy multiple choice. They made a profit of $6 million. You've got to eliminate intercompany profits because you can't sell to yourself. You can only recognize that profit when it's flipped and sold to outsiders. So GC made a $6 million profit. How much of that do I have to de-recognize? Well, they tell me that $6 million profit that they made on selling goods to YZ, how much did YZ sell to outsiders? YZ only sold half. That means 1/2 of this profit has to be de-recognized. 50% of the profit is okay. It's been sold to outsiders. 50% has to be de-recognized. So 6 million times 50%, the percentage that has to be de-recognized because it was not sold to outsiders. Let's say 30% of that was sold to outsiders by YZ. Then 70% would have to be de-recognized. It's just a coincidence this is 50-50. So 3 million of profit has got to be de-recognized because it has not been sold to outsiders. So the de-recognized profit, folks, is 3 million, but we only own 30%. So 30% of that has to be de-recognized. That's another 900,000. Coincidentally, the same number. What is my equity income? My equity income is the sum of those three numbers, 6 million minus 900 minus 900, equity income, 4,000,002. There's my equity income. And what's my ending carrying value? 75 plus my percentage share of the net income minus my percentage share of the excess depreciation minus the percentage share of derecognized profits minus my share of the dividends. What's my ending carrying value? 77,700,000. 77,700,000. That is the ending carrying value on the balance sheet, and we do not mark to fair market value. Okay. When a company consolidates, if you have control, you have to consolidate. It's called the acquisition method. You have to consolidate, okay? The parent is going to have their own financial statements. The parent's going to have their own income statement and balance sheet. The affiliate is going to have their own income statement and their own balance sheet. We have to consolidate. So what happens is on the parent standalone financial statements, on the parent standalone balance sheet, they are going to show investment in subsidiary, whatever that carrying value is. Upon consolidation, eliminate that account, eliminate that investment in affiliate, and instead pick up 100% of their assets, 100% of their liabilities, and insert, remember to insert goodwill on the consolidated balance sheet. All righty, so parent standalone balance sheet, they account for that investment using the equity method internally on their own standalone financial statement. Internally, they account for that investment just as we've done here using the equity method. But upon consolidation, they're going to get rid of that investment in affiliates, 77,700,000, and instead they're going to pick up 100% of the affiliates' assets at fair market value on the date of acquisition, 100% of their liabilities at fair market value, and then we are going to insert goodwill onto the consolidated balance sheet. Okay. Now, if there's non-controlling interest, that becomes part of consolidated equity. And I'll show you how to do that. We're going to do a consolidation in a minute. Okay. Now, on the parent standalone income statement, on the parent standalone income statement, they're going to have equity income. In this example, what was that? 4,200,000. Upon consolidation, we are going to eliminate that equity income, and instead we're going to pick up 100% of their revenue and gains, 100% of their expenses and losses. Okay, Consolidated net income is always going to equal parent alone net income using that equity method internally. But it has much greater disclosure, folks. Consolidated net income is going to equal the parent standalone net income, but boy, oh boy, a ratio is going to change. Consolidated net income divided by consolidated sales, no change to the numerator, but boy, your profit margin is going to be way lower, because if you look at the parent net income, that's going to be the exact same as the consolidated net income, but when you have the parent alone sales in the denominator much lower, the parent profit margin is going to be much higher than the consolidated profit margin, okay? Consolidated equity is always going to equal the parent equity using the equity method internally, plus any non-controlling interest. And the non-controlling interest, the size, the amount is dependent upon whether you use full goodwill or partial goodwill. All right, but that's the equity method of accounting. We use that whenever we have significant influence. All righty. Okay, not so bad. Guys, how we doing? You guys enjoying this? Sam, James, David, Chad, whoever's out there, you guys excited? You guys want to you sit for the CFA again? Like Sam, like you want to study again? What's going on?
My whole life is studying, Pete. Great job with this so far.
Nah, I saw you. I heard you whispering to James that James, you should be doing this. Pete's horrible. That New York accent, no one can understand him. Normally they'd have captions at the bottom translating my New York accent. Do I sound like I'm from James? Do I sound like I'm from New York, James?
About as New Yorker as a Ninja Turtle.
Oh, man. All right. James just recently got out of jail. Yes. So we're going to send you back to. No, he didn't. I'm only serious. All right. So where I was going with that, I have no idea. Let's do our next question. You ready? We got 3 more questions. Let's go, baby. Let's go. Chris Stone, a charter holder. Good for you, Chris. You see, Chris took UWorld. I know that for a fact. So, Chris, I can't start here. I have no idea what to do with this mountain of information. So, legalized cheating. Where do we go? We go down here. Compared to the method that Matheson used in previous cash investments, what's going to happen? I have no idea. It doesn't help me at all. They want to know. Assume we comply with U.S. GAAP. What's the amount of goodwill? U.S. GAAP, you got to use the full goodwill method. Now, how do you do the full? Now, see, this is going to lead me so I could read the facts in context. Okay, step number 1, I got to calculate the implied fair value for a 100% stake in this business, the implied fair value for 100% stake. Step number 2, I want to find the fair market value of the identifiable equity. If I bought 100%, what would be the fair market value of the identifiable equity? Okay, I can then calculate 100% of the goodwill. That's why they call it full. You could calculate all of it. You see, by reading the questions first, it gives you a path. You start controlling yourself, and you don't get bogged down by the mountain of information. They love to give distractor information that has no bearing on the solution. That's why legalized cheating is the way to go. Just make sure these formulas are coming out of your head and not a tattoo on your leg. That's right. I read somewhere, I think it was the bar exam, but somebody tattooed, I don't know, it was a permanent tattoo, but like some rules and stuff, and they got busted and all that kind of stuff. When I took the bar exam in New York City, they actually busted a girl with cheat notes. She kept going to the bathroom. It was obvious something was up. Either she had diarrhea or she was cheating, but they caught her in the bathroom with cheat notes. Now, I don't know if they were looking through the stall, because that would be invasion of privacy, but nonetheless, it was great for me. It broke up the monotony of the day. She came out crying. It was cool. All right, so here we go. Chris Stone, a charter holder. For Matheson Industries, her employer, duty of loyalty. Matheson has made a number of intercorporate investment in recent years, typically normally they pay with cash in exchange for 20 to 30%. So that would be for those investments, they would be doing significant influence equity method. And if they're paying cash, current assets down because cash is down, investment in affiliate, non-current asset up, total assets no change. So that's what they've been doing. Okay, now they generally take a board seat, so that means they have significant influence. All right, so they contribute to operating dividend decisions, but not influence dividend, but they take a board seat, they got influence. Now, Stone is in charge. A review, Stone, I'm thinking of Stoned. You know why I'm thinking of Stone? Because I took my kids to a Ranger game the other day, and as soon as we get out of the tunnel there, you start smelling the weed. I mean, like, you know, come on, man. You know, I mean, I want my kids to have brain cells for a little while, but nonetheless, the smell of weed is everywhere. I'm wondering how that's affecting the pass rates for all these high stakes exams. Is smoking weed helping or hurting? I don't know. But Stone is in charge of reviewing Matheson's largest investment to date. On January 1, here we go. They issued 4 million shares. They didn't pay cash. $1 par, but I'm looking for the fair market value. They bought 80%. Stop right there. That means you have control. That means you've got to consolidate. Now, if you only bought 80%, 1 minus the 80, 20% is the minority interest, the non-controlling interest. Now, they tell me the current market value of the stock is $20 a share. So 4 million shares. 4 million shares at $20 a share. Purchase price for that 80% stake, the purchase price, $80 million for that 80% stake. So I have one piece of the puzzle. I've got that 80 million. Now, on the balance sheet, they did not pay cash. Cash, no change. They didn't pay cash. So investment, a non-current asset, is going to go up 80 million, and then the parent equity, 80 million, gonna go up. Some of that's gonna go to stated capital, 4 million shares at $1 a share. 4 million in stated capital, 76 million, the balance in additional paid in capital. But equity went up, assets went up, no change. They didn't pay with debt. So the parent equity is gonna go up. Now, this is the information for both companies prior to the transaction. All righty, so the parent standalone equity prior to this transaction, so this is prior to the 45, the 65, the 150, and then they just issued another 80 million. All right, so total equity post-acquisition is going to be the sum of all these amounts. This is how we're going to get total equity post-acquisition. All righty, that 80 million. Okay, now the subsidiary, the company we bought, here's the fair market value of the identifiable assets, 140. Okay, the inventory, same amount, current assets, same, but the PP&E plus 15 million, we're gonna have to calculate excess depreciation. All right, so the fair market value of the identifiable assets, 140. The fair market value of the identifiable liabilities, 70. So here's the fair market value of the identifiable equity. So I'm going to take my purchase price. That was, how much did we say? $80 million for an 80% stake. 80 million, which equals 80% of the total fair value, right? They paid 80 million for an 80% stake. They did not buy 100% of this company. Okay, so what I want to do is I want to, step one, calculate the implied fair value. What is the implied fair value? So we're going to have to go back to high school, do some algebra, divide both sides by 80%. So we divide both sides by 80%. What is the implied fair value for a 100% stake? Therefore, the implied fair value for a 100% stake, implied fair value for 100% stake, step number one is complete, so we know that's 100 million. All righty, so I'm going to go back to my setup. Implied fair value for a 100% stake, 100 million. What's the fair market value of the identifiable equity? Fair market value of the identifiable equity, 70 million. So 70 million for 100% stake. So what's 100% of the goodwill? $30 million. That is 100% under the full goodwill method. All righty, so we got one piece of the puzzle. There is your full goodwill. Okay, now I want to continue this. You ready? Let's find the non-controlling interest. Okay, so let's keep going. full goodwill, what would be the non-controlling interest? So if we bought 80%, we did not buy 20%. Multiply that by the implied fair value for that 100% stake, 100 million. That's 20 million. That is the non-controlling interest under the full goodwill method. Okay, that is the non-controlling interest under the full goodwill. All righty. So that becomes part of your consolidated equity. That's going to be part of the consolidated equity. And the goodwill's got to be inserted on the consolidated balance sheet, 30 million. Okay, that's the beauty, greater transparency. All right, now what if we were doing partial goodwill? So let me now show you all this partial goodwill. Find some white space here, there we go. Okay, partial goodwill, not an option, not allowed under US GAAP. IFRS only. And under IFRS, they give you the option. You could do partial or you could do full. So how would you do partial goodwill? You ready? Step one, the purchase price for an 80% stake. That was 4 million shares. 4 million shares at a fair market value per share of $20. So that's 8 million. Okay. Now I want you to subtract from that the fair market value of the identifiable equity, the identifiable assets minus the identifiable liabilities. That was 70 million times that 80% stake. That's 56 million. So that's 80 million minus 56 million. Okay, so the fair market value of the identifiable equity, 70 million times that 80% stake, 56 million. So the partial goodwill, 24 million. That is 80% of the goodwill. Now I could check myself. You ready? If 24 million is 80%, what would be 100%? 24 divided by 0.80. What would be 100% of the goodwill? Oh yeah, 30 million. 30 million, isn't that right? 30 million. That's 100% of the goodwill. Right, 100% of the goodwill is 30 million. And I could work in the other direction. If the full goodwill is 30 million and I multiply that by 80%, then what would be the partial goodwill? Oh yeah, 24 million. You got your check figure. We know we're on the right track. All right, notice the difference. The full goodwill, 30, less the partial goodwill, 24. That's a difference of less the partial goodwill of 24. That's a difference of 6 million. That's also going to be the difference in your non-controlling interest. So the non-controlling interest under full goodwill, the non-controlling interest under full goodwill, we said that was 20 million, right? 20 million. You take the implied fair value for 100% stake, 100 million, multiply it by 20%. There's your non-controlling interest, full goodwill. Your difference is going to be 6 million. So what's going to be the non-controlling interest under the partial goodwill? It's got to be 14. If we don't get 14, we did something wrong. Okay, if we don't get 14, we did something wrong. Let's see if we can't calculate that 14 million now directly. All right, so partial goodwill, we know purchase price for an 80% stake, 80 million. Fair market value of the identifiable equity, 70 million. 70 million times 80%, 56 million, partial goodwill, 24. Take that fair market value of that identifiable equity, the fair market value of the identifiable equity, 70 million. Multiply that by the non-controlling interest, 20%. What's 20%? 14 million. There is your non-controlling interest under the partial goodwill. Same result, different format. Okay, $6 million difference in goodwill, $6 million difference in non-controlling interest, folks. So full versus partial. The goodwill, 30 versus 24. The non-controlling interest, 20 versus 14. A difference of 6. 30 minus 6, 20 minus 6. There's your difference. Because under partial goodwill, the goodwill is going to be lower by 6. That means the consolidated equity is going to be lower by 6. Under partial goodwill, the difference between partial and full goodwill, your goodwill's lower by 6, consolidated equity is going to be lower by 6. And remember, your consolidated equity is your parent equity post acquisition plus any non-controlling interest. And the non-controlling interest will either be under full goodwill, it'll be 20. Under partial goodwill, it'll be 14. But the parent equity post-acquisition is that parent equity pre-acquisition. Okay, the parent equity pre-acquisition, this all adds up to 260. Your net assets, 260 plus the 80, 340. Okay, 340. So consolidated equity is either going to be 340 plus 20 or 340 plus 14. So consolidated equity, full goodwill, 340 plus that 20, 360. Under partial goodwill, 340 plus 14, 354, a difference of 6. What's another way to get your consolidated equity? Consolidated assets minus your consolidated liabilities, same result, different format. There's your consolidated equity. With the consolidated assets, book value of the parent plus fair market value of the sub plus the goodwill. Let's see if we can't get the 360 full goodwill. What would be our consolidated assets? You ready? What would be our consolidated assets? We've got the parent assets, 580, plus the 140. So full goodwill. Parent assets, 580. Subsidiary assets at fair market value. What did I just say that was? Subsidiary assets, 140 plus the full goodwill. Full goodwill we said was 30. 580 plus the 140. What is that? Let's see. 580 plus the 140. I can't do math in my head. Let's see. Let me do it correctly. You ready? 580 plus the 140 plus the 30, 750. That's the consolidated assets. Now, parent liabilities, 320 plus the 70. 320 plus the 70. Parent liabilities, 320. Subsidiary liabilities at fair market value, 170. So let me just double check that. So that's 320 plus the 70, not 170, 320 plus 70. So that's 390. That's your consolidated liability. 750 minus the 390. Now, if I don't get 360, I'm going to cry, but I don't have to cry because we did it correct. We know what we're doing, consolidated equity. Why am I showing you multiple approaches? Because the way you solve at exam day is dependent upon the given information. All right, so you've got to be ready. Now, look, if it's partial goodwill, you still got the parent 580 plus the subsidiaries assets 140 plus the partial goodwill of 24. So instead of 750, 744 for the consolidated assets, lower by 6. And then your liabilities would be exactly the same, 390. There's your consolidated liabilities. Consolidated equity, instead of 360, 354. The difference being the size of the goodwill affecting the consolidated assets. And then the consolidated equity is also just the difference in the non-controlling interest, 20 versus the 14. Parent equity post-acquisition plus the size of the non-controlling interest. And there it is. All right, so let's see if we can answer another question here. So let's see. Compared, so we answered that one. Let's answer the first one. Compared to the method used in Matheson's previous cash investments, the investment in JT, we did not pay cash. We issued stock instead. So relatively speaking, since we did not use cash, our cash is higher, relatively speaking, because we did not use cash. Will we have a lower current ratio? Not lower. We're looking for most likely, a true statement. Since we didn't use cash, our current ratio would be higher, not lower. Okay. Would we have a lower debt to equity? Well, let's see. We used equity instead. We issued stock. So relatively speaking, our equity would be higher. Debt to equity would be lower. That is a true statement. Debt to equity would not be higher. It would be lower. Because we're using equity instead of cash, we'd have a lower debt to equity. Now, again, there's a sign to this, right? Folks, your return on asset times your degree of financial leverage is your return on equity. Degree of financial leverage is an amplifier. It amplifies your potential return as well as the risk assumed. Your degree of financial leverage, for our purposes in the DuPont model, either take your asset divided by your equity or 1 plus your debt divided by your equity. If your equity is higher and you've got a lower degree of financial leverage, we're assuming less risk because we didn't use our cash. We're keeping our cash available to service our debt, pay interest, pay principal. Instead, we issued equity. So the good news is we have lower risk. The bad news is lower degree of financial leverage, lower return on equity. All righty. Now, a strategic question. When would it be a good idea? When would it be a good idea to use leverage? So long as you believe your return on asset is going to be greater than your after-tax cost of debt. Your after-tax cost of debt. Borrow. Okay, the bigger the spread, the more confident you are, then you want a bigger degree of financial leverage. All right, because this is your hurdle rate when you use debt, your after-tax cost of borrowing, your yield to maturity times 1 minus the tax rate. But what's your hurdle when you use cash or you don't use cash? Your return on asset versus the opportunity cost. The opportunity cost on the cash. The opportunity cost on that cash. What was the hurdle? What was the rate of return you were earning on that cash? Probably pretty low, okay? Probably pretty low. That after-tax investment income on that cash is probably a pretty low hurdle. So it might be a good idea, if you're confident in this acquisition, to maybe use your cash rather than issuing your own stock. Okay, because that's a pretty low hurdle, the opportunity cost on whatever that cash was invested in. I mean, what kind of rate, even today, what are you getting? 3, 4, 5%, and then after tax, it's relatively low hurdle. All righty. Now, the key is how optimistic or pessimistic you are about the acquisition, right? So we'll see that in corporate finance. All right, let's try another one. So did we answer that question? We did. Answer that one, we did. All right, so here we go. Here's another question. Now, Stone questions some of the assumptions used in the fair value assigned to the assets. She believes the inventory is understated by 10 million. So folks, we have an excess over fair market value of identifiable equity, okay? So if we assign more of the excess paid, if the excess over the book value, if the excess assigned to the identifiable assets go up, then the amount assigned to the unidentifiable assets, the goodwill, has got to go in what direction? Down. It's got to go down, right? That makes sense, right? So the more you assign to the identifiable assets, the less you have assigned to the unidentifiable. Okay, they want to know, hey, what's that going to do to your minority interest if you're doing the partial goodwill method? So let's just see, what's that going to do? And let me get rid of this. I want to have some space here. So partial goodwill, we're going to change the facts. You ready? Partial goodwill. So we're changing the facts. So we have, let's see, the fair market value of the identifiable assets is going to go up by $10 million. So the fair market value of the identifiable assets, that's going to go up by 10 million. All righty. So the fair market value of the identifiable assets, the fair market value of the identifiable assets was 140. We're going to increase that. Okay, the fair market value of the identifiable assets was 140. Was 140. We're now going to increase the inventory. We're going to increase that by 10. So the fair market value of the identifiable assets is now going to be 150. The fair market value of the identifiable liabilities, no change. What was the fair market value of the identifiable liabilities? Let's see, the fair market value of the identifiable liabilities, no change. Come on, man, where is that number? 70. All righty, so fair market value of the identifiable equity is now, let's say, 80. All right, partial goodwill method. You ready? Partial goodwill. So the purchase price for an 80% stake, purchase price for that 80% stake, no change. 80 million in stock, Fair market value of the identifiable equity is now 80 million times 80%. So that is now 64 million. So that means the partial goodwill is now lower. It's 16 million versus what it was. The partial goodwill, let's see, the partial goodwill was 24, okay, versus 24. All right, so the partial goodwill is going down. Now the non-controlling interest, the fair market value of the identifiable equity, that 80 million times 1 minus that 80%, 20% stake. The non-controlling interest, coincidentally, is now 16 million. That was 14 million. So it did go up by 2 million. The non-controlling interest under the partial goodwill method went up by 2 million. All righty. So the partial goodwill did go up by 2 million. So they want to know, true or false? An increase of 2 million in the minority interest of partial goodwill, that is a true statement. Now, why is B incorrect? And this is another thing I love about UWorld. Not only do we tell you why the right answer is right, but they spend a lot of time in the written, detailed, explanatory answers telling you why the wrong answers was wrong. Why are choices 2 and 3 false? Total assets would increase regardless of whether full goodwill or partial goodwill is used. That's a false statement. Why? Total assets, no change. Total assets, no change. The identifiable assets are going up by 10. The unidentifiable assets are going down by 10. We just moved it from unidentifiable to identifiable. Okay, so the unidentifiable assets are going down. The identifiable assets are going up by 10. So total assets, no change. Okay, and then the full goodwill method. Well, let's see. What would happen under the full goodwill method? So let's go back wherever I had that set up, right here. What if we were doing full goodwill method? So this was partial goodwill. All right, what if we were doing full goodwill? So we again paid $80 million for an 80% stake. Step number one, we divide both sides by the 0.80. So implied fair value for a 100% stake is therefore 100 million. Now, the fair market value of the identifiable equity, that would no longer be, that was 140 minus 70, that was 70. Okay, now the fair market value of the identifiable equity is 80. Okay, so instead of being 70 million, which it was before, we're adding 10. So now the fair market value of the identifiable equity, 70 plus the 10, 80, 100% stake. All righty. So your full goodwill is now 20 million. It was, the full goodwill was how much? 30 million. The full goodwill is going down by 10 million because we just assigned that 10 million to inventory, an identifiable asset rather than unidentifiable. The non-controlling interest, full goodwill, non-controlling interest, full goodwill is based upon that implied fair value for 100% stake. So 100 million, no change, times 1 minus the 80%, 20%, no change. The non-controlling interest, 20 million. Same as it was before, no change. Under full goodwill, the amount assigned to the non-controlling interest does not change. Under the partial goodwill, it does. Under the partial goodwill, it was 24. It's now 16. Okay, but under the full goodwill method, the non-controlling interest doesn't change because we calculate it using the implied fair value. That didn't change, and multiplying by the non-controlling interest, that didn't change. So that's why that third choice there is incorrect. Okay, choice number 3, false statement, wherever that was. Okay, the full goodwill method, the reported goodwill is going to be higher. No, it's not. Okay, it's not going to change. That's a false statement. All righty, how we doing on time? We got time for another one? What do you think, Sam? One more for good luck, and then I'll take some questions if there are any. What do you think? Hello? Sam, you still there? Is anybody there? Holy crap, have I been talking to myself?
Let's do it.
Would you all fall asleep? What's going on? All right, let's do another one. For good luck, you ready? Here's all your facts. I have no idea what to do with all these facts, no clue. So where do I go? The question stem. They tell me Sims complies with IFRS and they recognize minority interest. Okay, remember that's an option. They could do full goodwill. So we're thinking implied fair value for a 100% stake, implied fair value for that 100% stake, minus the fair market value of the identifiable equity, 100%. That's how we will get 100% the full goodwill. Okay, cool. Now, they're preparing their post-combination consolidated balance sheet. Jane is an analyst at Sims. Her employer, duty of confidentiality, believes the book value of Kirk's inventory is undervalued again. So folks, if the identifiable assets go up, the unidentifiable assets go down, dollar for dollar, full goodwill, just like we saw. If an adjustment to fair value were made to account for that analysis, what's the most likely change to the post-combination consolidated balance sheet? Well, the inventory would have to go up, the goodwill would have to go down. Which one says inventory up, goodwill down? Nothing to do with minority interest. We just saw the minority interest is not going to change. Why does the minority interest not change? Because the implied fair value for a 100% stake does not change. times the minority interest, that does not change. So the minority interest, that does not change. Do we have a decrease in reported goodwill? Yes, we do. Do we have an increase in total assets? No. Total assets, no change, just change in form. Total assets, no change, just that the inventory will be higher, the goodwill will be lower. All righty, the goodwill will be lower. Now, correct answer, choice B. Now, I want you to think about how they could test this kind of backdoor. Would a company want to do this? Would a company want to assign more to the identifiable or less to the identifiable? That is the question. Is it to your advantage to assign more to the inventory? No. Why not? Because if the inventory is on the books at a higher amount, when you sell that, the cost of goods sold is going to be higher. If the cost of goods sold is higher, then the consolidated profit is eventually going to be what? Lower. Goodwill, no amortization. Now look, there is a disadvantage in the sense that people get very nervous when a large percentage of your assets, total assets, is in goodwill. I get that. But in terms of future profitability, you don't want more assigned to the, you don't even want more assigned to the PP&E, because the more that's assigned to the PP&E, that excess depreciation is going to go up. What's that again going to do to the parent net income, the consolidated net income? Lower it. So in a theory type question, all things being equal, you know what? If you're looking to maximize consolidated profitability, you want to assign more of that purchase price to goodwill and less to identifiable assets that you will eventually have to amortize or depreciate that additional amount. Okay? Be on the lookout, by the way, for in-process R&D. That is generally another asset that is not on the balance sheet of the subsidiary, but it has a fair market value. So you got to read carefully. Don't just look what's on the balance sheet. There might be in the notes in-process R&D that you got to add to the fair market value of the assets that are on the balance sheet. All righty, when that balance sheet is marked to market. Don't forget to insert the goodwill on the consolidated balance sheet, right? The goodwill does not appear on either company's balance sheet standalone. That's only on the consolidated financial statement. Okay, so I think we got just enough time here for a couple of questions on the back end. So I got to put back up here. I know. I was supposed to show something cool, and let me get that back up. All right, so you guys have seen that. So anybody who joined us late, we are very grateful for your attendance. I know this was relatively long, but we're looking to earn your business, folks. We shop around for the silliest of things: clothing, shoes, cars. This is going to change the trajectory of the rest of your life. Level 2 is the obstacle, man. Level 1's not that big of a deal, and boy, if you get through level 2, level 3 you're going to get through. Level 2 is the big one. All right, so you got to get through this. So you got to choose the right course. So we appreciate your time tonight. Because you attended, you're going to get this discounted price, that QR code. We also want to get your input. We'd love to hear from you. We're looking for testimonials. So look, we want to earn business, and with social media, the way everything is sold today through influencers. We want you, to the extent that you think or you want to sample our product, we would love for you all, but the truth though, whatever it is, but this is what sells courses today: CPA, CFA, bar exam, whatever it is. So if you think we're worthy of a testimonial, we would love that. You just answer a couple of questions, and then the 25% off again is our thank you for attending tonight. But yeah, that's all I got. I feel like I just gave birth to a level 3 candidate. Oh my goodness. So guys, what do we got? Any questions for me? Anything I can add, any value? I don't usually have any value, but if I have any, Sam, anybody, is there anything I could do? Hello, any questions for me?
Hey, sorry about that, Pete. No, you know what? There were just some people who had a few questions just about if they could get the recording for this and
Yep.
that sort of thing. But as far as substance, I think you explained it all pretty well, and there wasn't anybody out there who we have any hanging questions. There is somebody, and I'll pass this along, but somebody wanted to know, when you were talking about at the beginning, like the held to maturity debt, that he wanted to know the having the held to maturity debt hurt Silicon Valley Bank, right? And I know that's not part of the curriculum, strictly speaking, but
So their investments in held to maturity.
yeah, I mean, this was like at the beginning of your materials when you were just talking about the less the majority interest.
Yeah. So, well, I'll tell you how it ties to the CFA curriculum is,
Yeah.
strategically, if you think interest rates are going to go down on the debt you hold and you think the fair market value is going to go up, you would certainly want to get that unrealized gain on your income statement. So you would want to classify it fair value through P&L. If you think rates are going to go down and the fair market value is going to go up, you probably don't want it on your books at amortized cost, nor do you want it listed as available for sale, fair value through OCI, because when it's good news, you want that good news to flow through your income statement to hit your retained earnings, to hit your equity, right? So assuming those debt investments were in entities where the rates were going down and the value was going up, being on the books at amortized cost would hurt them, because chances are the fair market value would have been above the amortized cost.
Right. And one other question that just came in. So you mentioned you don't teach ethics, but one of our attendees wanted to know that in addition to FSA, what other sections do you typically teach?
I am the derivatives man, the equity man, the debt man, pretty much portfolio management. I mean, most topics I don't do the econ, I don't do the ethics. Yeah, alternative investments. I mean, I pop in, on the videos on a variety of different courses, classes. I'm on the live online. Oh yeah, I should mention, folks, the virtual live online. We just saw that. Sam, what was that? February 17th? Is that right? The Saturday live online. So look, there's, don't delay, because if you're looking to sit in May, you want to start studying sooner rather than later. But the Saturday live online starts February 17th. But guys, we have an awesome, awesome team. I mean, I'm one person here, but honestly, the brain trust behind me blows me. I kid you not, two-tail, my IQ's in the left tail. Sam and James and those folks, David, their IQ's this way. Skews it to the right, making me look even dumber than I already am. So look, I'm a part of this team, and I'm happy to be a part of it. So I will see you guys in the accounting, the derivatives, the equity. I'll see you portfolio management, a variety of different topics, but really a phenomenal team. And I think on the live online Saturdays, a lot of Darren DeGraff. If you know Darren, he's got every credential under the sun. And in addition to being one of the smartest people I know, he's probably one of the nicest people as well. It's just really good folks here at UWorld, so your questions, everybody's a team effort here. We're always happy to help you out. But yeah, I'll see you in most topics, but not the ethics. As I said, that doesn't come to me intuitively. No more to say on that. And yeah, the econ, I'm not we got PhDs in econ who can run circles around me, so I defer to those folks.
Well, and finally, we did had a few, thank yous. One of our attendees has indicated that Peter and Darren really helped me a lot through level 1. So thank you for that. And hopefully we will be able to get you through level 2 and then level 3 after that. So
love it. So on behalf of everyone, Sam, I'll let you close, but I just want to thank you guys sincerely for your time tonight. Again, that testimonial, if you feel that we're worthy, boy, does that help us. It helped me and help us as a course get the word out there. We'd love that. So in that 25% off, that's pretty cool. And Sam, I'm going to say goodbye, but Sam, it's all yours to wrap it up.
Thank you, Mr. Olinto. So again, folks, thank you so much for attending tonight. We really appreciate your time. And if there's any other questions that you have on this, that you can certainly put them through, and we could either get them to Peter or somebody else here within UWorld might be able to field those and answer those as well. And again, thanks for your time, and we hope to see you down the line.
Let's go! See you in level 3, or actually level 2, then level 3. See you guys later. Good night.
Have a good one. Thank you.